got no muscle, no hustle, no backbone. I stand alone, not tripping, just saying I'm different. Ain't hanging on to the coattails of the...
Hi, this is Mr. Not Advice. Thanks for joining me for this podcast today. Please remember that this podcast is for informational purposes only. Nothing in this podcast should be construed as an offer to buy or sell anything, nor should it be construed as specific advice or advice in any manner from myself or any of my guests. Thank you very much. Good morning, good afternoon. This is Mr. Not Advice. Thank you for joining me today on my podcast. I've got a extremely special guest today, Mr. Jake Donoghue, who has varied background both in the crypto space, politics, working deeply with some of the top crypto companies that are out there, having also helped create his own crypto coin. He's got a book coming out on worldwide release on August 22nd called Crypto Confidential. And I have to tell you, I'm super excited to have him here because he is going to share some of the, I guess, more unseemly activities and players that are within the overall crypto space. And with that, Jake, I'd like to welcome you to the podcast today. How are you doing today?
Thanks so much. Yeah, no, it's an absolute pleasure to be here. I'm doing really well. Yeah, doing well. Enjoying the last few weeks of summer.
Does it actually stop raining in the UK when summer is on you, or do you still get rain every day? US-centric people think that it rains every day in Britain.
Hasn't been too bad the past couple of weeks, but these are really the only 2 weeks we've had of summer. The rest has just been complete washout, to be honest. So yeah, the stereotype is correct.
Would you mind just sharing, I guess, your background and some of the high-level things that you have done? You've had quite the professional experience, varied, and it really surprised me looking at your CV. And I know today we're going to really focus in on your crypto experience, but would you mind giving our listeners an overview?
Yeah, absolutely. So thanks again for having me on. I've been really looking forward to this episode. I used to work in the crypto industry. So back in 2021, when the altcoin markets were really, really kicking off, me and some contacts of mine launched our own crypto project, which did remarkably well on launch, as was to be expected back in those days. So we listed at a $3 million market cap, and that went up by about 11 or 12,000% on the day of launch within the first hour, actually. So from 3 million went up to $300 million market cap on the day of listing. Out of that, we then spun a number of other projects. The main venture was a marketing communications consultancy we set up. And it was really at that point when we set that up and started taking on clients that I really got an indication of just how bad things were in the crypto space. We were working with, like you just said, some of the biggest names in the industry, some of the biggest exchanges, some of the biggest projects, some of the biggest companies. And it's really got an indication of how, first of all, how pervasive fraud is. And second of all, just the sheer scale of it and the efforts that these crypto founders will go to enrich themselves, enrich their contacts, and the kind of cartel, as it were, of people at the helm of the industry. So we set that up. Business did really well. We never had to take on any kind of debt financing. We didn't have to give away any equity in the company. We had revenue and profit from the start, and quite substantial revenues and profits from the start. Such was the demand for marketing crypto projects back in those days. But then I left the industry at the end of 2022 following the collapse of FTX. Things just became untenable, and just the sheer scale of malpractice that I'd seen over so many months and years just became unpalatable. So I got out of the industry and wrote a book, basically blowing the whistle on a lot of the scams or these frauds that take place, and also the way they're orchestrated. So the mechanics underpinning them, and also the mindset of the people who are pulling off these grifts as well, and really kind of showing how these crypto bros act when the cameras are off, behind the scenes. So yeah, like you said, that comes out next week, Thursday, the 22nd of August. And yeah, really excited for that. Hope it gets widely read. I think it's an important message, and I think a lot of people would benefit from hearing it.
Would you say that some of the things that you're going to go into, are they endemic of the industry? Are they endemic because of the early stage that the industry is in, or a combination of both?
They're endemic to the industry, and I don't think it's because of the early stage the industry's in. I mean, one of the most common catchphrases within the industry is "we're so early." I think that's completely false. I think the industry has been around for a very, very long time now, relative to some other nascent technologies which have accomplished a lot more, innovated a lot more, and achieved a lot more within a shorter frame of time. So I don't think it's because of how young the industry is at all. I think it's unique to crypto. Crypto has a very unique set of incentive structures. It's in a unique kind of regulatory position, as it were, and there's really nothing else like it. And I think all of that combined, and also combined with the type of person that it attracts as well, all of that kind of creates what you might call a perfect storm of fraud and corruption. So yeah, I'd say it's the industry as opposed to any other.
Do you think that from a regulatory standpoint that the regulators are playing catch up, or are they actually empowering some of the fraud we're going to talk about today and theft that's going on within the crypto space?
Yeah, it's a good question. It's a complex issue. This I think there's an element of them playing catch up. I think with any new technology, with any new kind of industry which emerges pretty much overnight, it's going to take regulators a while to get to grips with it, get to grips with how it operates, especially if it's in a niche and emergent and technical space like crypto is. That being said, though, it's not like you need to rewrite the entire rulebook for crypto. A lot of financial regulations can and should be applied to cryptocurrency. I mean, for example, the classification of crypto as a security, as a commodity. Everyone in the industry wants crypto to be a commodity. Commodities receive lighter regulation. They're regulated by the CFTC as opposed to the SEC. It's a smaller agency. They have less resources and they have less enforcement powers. Now, that's what the crypto industry wants. Unfortunately, crypto, in most cases, does not look very much like a commodity. It looks like a security under the Howey test. The Howey test being very robust, very versatile, very long-standing way of designating securities. A lot of crypto does fall under that. I think that one of the big problems with regulation is that the industry is very evasive. It's very well funded. Some of the best lawyers in the world, some of the best law firms in the world are working for the crypto companies. They're on the crypto payroll. So they prevaricate a lot. They equivocate. They kick the can down the road, and they often tie up regulators in lawsuits as well. I mean, look what Ripple and the SEC that went on for a very, very long time. It cost the SEC untold millions to do that. These crypto companies, are very well versed in lawfare, in weaponizing the law for their advantage against regulators and also against other crypto projects and other crypto companies, which perhaps we can come to in a second.
How about we do this? Why don't you, can you give some of the worst practices, the worst things that you saw during your time in the crypto industry?
Yeah, absolutely. So a lot of these things happen, a lot of the problems happen, a lot of the worst things happen before crypto tokens even launch. So raising funds for launching a cryptocurrency is a really interesting, and again, this is one of those kind of unique aspects of the industry. Selling a crypto token is basically a way of fundraising for a company without having to issue debt or issue equity or raise debt. You're raising funds by selling a token. These tokens they're created out of thin air. There's nothing backing them. They're just code out there with no substance behind them. And increasingly, it's becoming a lot easier to launch tokens. And now with some of the meme coins, which we can maybe discuss in a second, anyone can do it. You don't need to have a technical background. You don't need to know what Solidity is. Anyone can launch these things. So you're raising money in a non-traditional way without any debt or equity. You're taking a startup public as well, which is, I think, quite interesting. You're taking crypto projects are predominantly startups. You're taking them public. They don't have revenue streams. They don't have any business models. They don't have products live. Often not even like an MVP, and often they don't have structures and processes in place. So they're not very good businesses. So, I mean, it's an interesting, kind of route to market that they go down, and that's really where the malpractice starts. So, for example, when you're listing these tokens on an exchange, on a centralized or decentralized exchange, and conducting a token sale, it's the project themselves which sets the price of the tokens. So, by contrast, if you're a company, taking a company public and you're floating it on a stock exchange or whatever, you're hiring an investment bank to come in and do the valuation. They'll do the valuation, and the company will then float at the valuation set by the external investment bank. It's a highly regulated process. There's a lot of oversight and a lot of scrutiny on it. That could not be further from the truth of what happens in crypto. In crypto, it's just the team that decides what price there's no oversight, there's no external consultant or advisor inputting into this. They just come up with a number. Often what happens is they'll set that number deliberately low. I mean, it should really be low anyway, because like I said, these companies don't really have any valuations because they're shells, they don't do anything, they don't make anything, they have no revenue. But anyway, what they'll do is they'll set it low and then they'll publicize that and they'll call it things like a low cap gem, so that they can then go off and shill it and then create this kind of sense of FOMO. So they can then give this message to their influencers to put out there, and then people will be attracted by this low value company in the expectation that it's going to instantly increase in value when it launches. Which back in the altcoin frenzy in 2021, that was very much what was happening in most of the cases. And then also when these tokens are being added to exchanges, centralized exchanges, it's also not only is the team setting the listing price themselves, but they're also the ones to add the liquidity to these, especially with decentralized exchanges. They're adding the liquidity. With the centralized exchanges, sometimes there are liquidity requirements that they impose on the projects, but not so often. And again, no oversight. It's just complete finger in the air how much liquidity they add, and often they add nowhere near enough. Now, this liquidity that they add, that needs to come out of their own back pockets. That comes from pre-sale funding that they've taken on, these pre-sale allocations that they sell, and then they need to add some of that to an exchange so that the token can actually be tradable. So that incentivizes them to add as little as possible. So then, it makes it very illiquid. It often makes it very illiquid, especially if there isn't so much demand to begin with and people aren't depositing liquidity into these pools. It makes it very liquid, difficult to trade. And it's just a pretty shambolic process all around.
I remember I got into business back in 93, and that was right at the end of the U.S. penny stock boom, which sounds very similar to like crypto. But then we went into the ISP boom in the mid to later 90s, where you had ISP guys, they famously, I always share that we had guys coming to our company and they operated out of the garage, and they had effectively gone out and bought routers and switches, and they were going to start their own ISP. And, at least there was some road to revenue. But what I'm hearing from you is, these crypto, these tokenization companies, there's no revenue. They're not putting any capital in. And you're right, on the investment banking side, we had to justify to the SEC why we were going to set the stock price for the IPO or the private where it was at. And we also had an accredited investor rule too. If it was deemed to be really aggressive, depending on which filing we use, only accredited investors. So, you had to have over $1 million in liquid assets, 10 million net worth. And so is there anything like that in crypto where at the very least it's not allowing the small investor, the one that can't afford to lose, a couple $1,000s in this type of crypto scam? Is there anything like that in place?
No, absolutely not. Nothing like that. And really, that is a fundamental aspect of the entire industry. It's this idea of decentralization and permissionless access as well. Imposing those kind of. So, I mean, some places actually do try to do that. Some places will try to impose KYC on these, on these token sales and things like that, either to give a facade or a veneer that they're protecting investors, or because they're running marketing campaigns and promotion campaigns in regulated jurisdictions, and so that the US or the UK, or because these companies that are launching are based in the UK or the US or something like that, as opposed to exotic offshore domiciles like Panama or Curacao or the Cayman Islands. But those KYC processes are incredibly flimsy. That it's incredibly easy to bypass them. You can buy KYC documents, for an exchange for $100. If you want to use an exchange which isn't available to US customers, you can buy that, KYC accounts for, $100 on Telegram. It's so easy to find. Or what happens is that they just don't enforce that particularly, rigidly. You can just use a very basic VPN to bypass that. Set your VPN to wherever, somewhere that's not subject to KYC requirements, and access it through there. But even that, even those places that do, enforce kind of KYC requirements, that's very, very few of these token sales do that. And especially back in, when I was active working in the space back in 2021, no one was doing that. No one cared. They wanted to get as many people in as possible. And they didn't care if people put all their money into it. That there was no kind of, fiduciary care from the sellers onto the buyers, onto the investors, or anything like that.
Is there any regulation, or is there anything in place that prevents the issuers, right, of the coin from selling into the initial demand by retail?
Yeah, I mean there are, yes. A lot of, back in the ICO era, what in 2017, when these initial coin offerings were taking place, what really kind of ground that to a halt was the SEC bringing a lot of enforcement action against unregistered sale of securities. I think it was sometime, I can't remember the specific month, but sometime in 2017, they issued an investigative report which found that these ICOs back then were raising crazy amounts of money, like billions and billions. The EOS ICO was, I think, around 4 billion, which was bigger than the raises for like the three biggest equity rounds that year combined. So I think that was Uber, Jewel, and Epic Games, actually. Yeah. So the EOS raised more money than Uber, Jewel, and Epic Games combined. And it was a long ICO process. And obviously, with that amount of money flowing into crypto, it obviously caught the regulators' attention, and they started bringing enforcement actions against these things. So yeah, there is regulation. I think a lot of projects either just don't care or just take steps to avoid that. So what will happen is they'll set up shell entities in, I don't know, the Seychelles or the BVI, the British Virgin Islands. And so technically they're not, UK or US or, regulated companies. They're in these jurisdictions. And what they'll do as well, to add further protection, I discuss this in the book, actually, it's really important. It's a really interesting and quite important aspect of it. What they'll do is the law firms in those kind of places are all in on this as well. They'll hire some of the best law firms over there to issue legal opinions, which are favorable to the crypto projects. So, for example, our project was a kind of win-only casino where you say, you input your bet, and then if you win the payout, and if you lose, you don't lose your initial stake. So if you make an incorrect bet, you get your money back. So we can discuss that in more detail actually a bit later. Actually, it's I call it in the book an economic fairy thing. Industries like gambling very much are regulated. So you have to get a legal opinion saying that you're not a gambling company. And these legal opinions are all up for sale. So you go to these law firms and you say, I need an opinion about that we're not a gambling company. And they say, okay, that'll be $15,000, $20,000. You then go down the road to their competitor and you say, okay, I've been offered $20,000 for this opinion. What price can you do? And they'll say, okay, I'll do it for 10. And you go down the road again and they offer 5. So it's really a race to the bottom here where these legal opinions are up for sale. What that does is it offers you complete protections. If the regulators, for whatever reason, in these jurisdictions do come after you, which they don't because the judiciary systems are very flimsy there, you can then point them in the direction of the lawyers and say, well, actually, the lawyers said we're in the clear here. The lawyers don't care because they have indemnity policies covering them for that, so they're insured against this stuff. So,
excuse me, are you saying to me that that some of the legal firms that are involved are effectively pay to play, that you can bargain and get a legal opinion that is worthless and only meant to cover the issuer's ass?
Yeah, absolutely. I mean, they're very much not worthless, though. They're very important because they do actually protect you from prosecution. If you do get prosecuted by regulators or whoever the authorities in these jurisdictions, this legal opinion will protect you. The thing is, they are all up for sale, and often these law firms will give an opinion about whatever you're paying them to do. I mean, they don't care. They want the fees, and they have insurance policies covering them if they then get fined by the regulators. So they don't care. They'll pretty much say anything. You can pay them to do that, and often you don't even need to pay them very much because they're all competing with one another.
Okay, so let me ask you this question. Using this example as a template, what percentage of the crypto business do you think is fraudulent or has fraud either on purpose or because the regulations don't exist to identify and then actively do something about it? What percentage of the industry would you say is unseemly?
I mean, pretty much all of it. I'd say every one is either doing something illicit, doing something fraudulent, doing something which, if it was a regulated industry, like if it was a normal finance industry, doing something which would lead them to be prosecuted. Either that, or they're aware that these things are going on. They're right in front of their face. Their business partners or their contacts or whoever is doing it as well. It's very difficult for crypto companies to operate without fraud. Like I said, a lot of these, or without any kind of malpractice. Most of these projects don't have any revenue. The only way they're able to raise or to make money is by just dumping their own tokens. So what they do is when they launch these tokens onto the market, like we were just discussing, they'll set aside team allocations for themselves, and then project allocations, and then they'll just dump that into the into the market. Now, selling tokens is questionable morality and legality, but it's also the way they go about it which makes it so bad. So what they'll do is they will, before they go ahead and sell their tokens, they'll try to bring additional retail into the retail interest into the token. So they'll try to drive up the price. So if the token's live, they'll send out announcements, for example, of positive news stories, say they just listed on an exchange or they just announced a partnership or whatever. Then they'll send that round to their influencers. Now, these projects, they have group chats on Telegram with 30, 40, 50, sometimes even hundreds of influencers in them. And these influencers themselves will either be on the payroll, they'll be getting paid by the project, or they will also have received token allocations. These influencers will send this news round, that will pump up the price. They'll then have their market makers on standby to liquidate tokens into the pump. So, that's one of the ways that, they do insider trading is facilitated.
My question that I'm curious about then is, if there is so much fraud, and maybe you can give me an example, but if there is so much fraud, I mean, if you're listening to this and you own crypto, I'm sure your response is, no, that's not true. That's not how I own Ethereum, or I own Solana, or I own Bitcoin. There's no fraud there. I mean, what would your response be to that? And would you also provide maybe a couple examples of, some of the insider trading or some of the most extreme examples of fraud that you saw in the space?
Yeah, sure, absolutely. So just because this is a misconception as well that a lot of people in the industry have, just because it's a large project, just because even if it's a layer one project, so some of those layer one blockchain networks themselves, as opposed to just random token on a network. Just because it's a large project does not mean that their hands are clean. I mean, what we saw a lot was, so first of all, it's necessary to establish that there's pretty much no one actually using this stuff. People are trading the tokens, then, whatever, they're speculating on the prices, but very few people are actually using these networks or these products that crypto projects launch. So take an L1, for example. What they will do if that no one's making transactions on the network, if they don't really have any users, but they have a token which people are speculating on, which has a high price, and they might be a prominent project. But what they'll do to make it seem like there is interest, apologies, to make it seem like there is interest in their network and that there are people using it, they will wash trade transactions on the network. So they will just send money, or they'll write a script that just sends money between two different wallets backwards and forwards. And then what they come out and say is, well, look, our network has processed X billion, like $10 billion worth of transactions in the past month, or something like that. But really, that's just washed as well. What we saw in the last cycle was an extension of that as well. We saw these projects really, really desperate to get actual users and actual projects onto their onto their network. So what they did was they essentially bribed people. They set up a lot of grant funds on their networks, and they basically just issued grants to projects to build on their network, because they had to pay people to come and build on their networks, to build products on their network, because nobody actually wanted to do that anyway. All people wanted to do was speculate on the token price. No one cared about using the product.
Institutions, and how much is being taken down by just everyday retail?
The institutions are somewhat involved in crypto. So the institutions are launching ETFs. They're filing for ETPs, exchange traded products. BlackRock, JP Morgan, whoever, they are launching these ETFs. They're doing that because they want the trading fees. Other institutions are happy to act as custodians, so they're happy to custody crypto funds on behalf of projects. But again, they're acting as a service provider there. Other institutions, more risk-tolerant institutions like hedge funds, they might speculate on crypto markets. I mean, hedge funds will, a lot of them will just have a punt on anything. So they'll speculate on the price. They'll act as service providers or facilitators, and they'll launch products for people to buy into. But beyond that, the institutions, they're doing that for the fees. They're doing that because they're happy to take crypto people's money. But no institution is actually using this technology. The technology really doesn't have any substance to it. I mean, Jump Crypto, which is was one of the biggest market makers, liquidity providers, kind of trading firms in the space. It's an extension of just Jump Capital. Yeah, just a kind of traditional market maker, or they have hedge fund divisions and that kind of thing. And they have a crypto arm. Jump Crypto has just announced, I think this week or last week, that they're going to unwind all of their DeFi positions. They're going to unwind all of their decentralized finance positions. So all of their decentralized finance activity, they're going to bring to a close, because the decentralized finance is really, again, it doesn't have any substance. There's no interest in it anymore. Decentralized finance being, money markets on the blockchain. So borrowing and lending without any intermediaries. In the last cycle, it was really the most prominent narrative that there was. There was a lot of money flowing into DeFi, and a lot of total value locked, so TVL. So billions of dollars were locked into these protocols, and they'd be borrowing and lending from user to user. Now, the interest in that has completely dissipated. One, because it's not actually decentralized, and people realized there was a false narrative. The projects and the teams which launched these so-called DeFi projects, all these projects have backends to them. So the code is able to be altered by the centralized teams, and that's very obvious. So it's a completely false narrative. It was a marketing narrative. They're also very unsafe as well. They often get hacked. They're often the subjects of very high-profile hacks. These code bases, these smart contracts, which store this money, which these projects are built off of, are very unproven technologies. And after so many hacks, people rightly started getting quite wary of it. So turning back to the institutions, yes, I mean, they're happy to take crypto money, but they're not actually using the technology. And in fact, I think very, very few people are using the technology.
Sounds a lot like the 2000 and 2003s when, in the CDO and mortgage, the residential mortgage CDO, CLOs, where the investment banks were pumping out all this product, but they carried zero liability because they were making the banking fees and the transaction fees, and they didn't really care. When you tell me about Jump Capital, are you saying that they're unwinding their DeFi positions because, what would your reasoning be? Because there's nothing behind them and therefore they want to get out beforehand? Or is it they're adjusting to a changing regulatory environment? Or they just, like I said, they just think they're junk and they've made their money?
I think Jump took some pretty heavy losses. I think Jump was also investing in projects, and a lot of those projects basically amounted to nothing. So I think they were taking losses, and now they're trying to liquidate their remaining assets. I think with volumes down in the space, market makers are becoming less profitable. All the volume in the space is washed. There was a report by the South Korean regulator that said that 98% of all trading volumes on crypto exchanges is washed. They're unwinding their position, they're unprofitable, and crypto is just not a very profitable space anymore. I think a lot of the market is just pumped up it's held up on thin air, it's held up on false narratives, and there's really no user bases. There's no new inflows of capital coming into the space. With the ETF launches, that was pumping some of the majors up a bit, Bitcoin and ETH, but nowhere near like we saw in the last cycle. So I just think there's a lot less interest in the space now. I think that the damage that FTX did reputationally to the industry after their collapse really is still very much there. No one really wants to go near this stuff. In the last cycle, we saw so much just crazy experimentation. And there was so much interest in this stuff. People were launching, for example, I don't know, like Walk to Earn was a thing where you download an app and you buy this NFT and you earn cryptocurrency just by walking around. It tracks your steps and you walk around. So, there were stories of the people who worked at this company. They were just walking around their car park all day and just earning crypto. And just, stuff like that. People were, Nike, for example, launched an NFT tied to a pair of sneakers. So the NFT verifies your ownership of the sneakers. And this kind of thing, there was just so much crazy stuff happening. But one of the weirdest things that was happening actually was self-repaying loans. This was just completely wild. You could take out a loan and never have to pay it back because you deposit $1,000 into this protocol, which is lending the loan. They would then send that out into the DeFi markets, into what was called the yield farming markets, these decentralized borrowing and lending. And the APYs and the APRs that you got from these DeFi lending markets was insane. Sometimes it was thousands of percentage per year. So what they would do is they would take your $1,000 and give you $10,000 back. So you're basically getting a $10,000 loan with $1,000 collateral, which you would never have to pay back because they would use your $1,000 and put that out into the market and yield farm it. So there were stories of guys buying boats with this, buying boats off these kind of things and just never having to pay them back and everything like that. The important thing to note with that is that the loan that you were receiving was in the native cryptocurrency of the project as well. And in a lot of cases, you were receiving the native currency. That's why, that's why they're not just depositing their own $10,000 and yield farming it themselves. So they're paying you in their own token for your stable coin. So your coin linked to the US dollar, and then they were going out and farming with that. So it was really crazy stuff, and that stuff generated headlines, self-repaying loan or, walk to earn or stuff like that. And, a lot of these things didn't make any sense and the business models were completely flawed. That's why they're not really around anymore.
So as I listen to you, it all makes perfect sense. But at the same time, I see this drive from, I guess, the professional investment community for people to adopt crypto as an asset, right? We have the ETFs launching. We've got guys like Saylor out there with MicroStrategy, people going crazy over Bitcoin mining companies. And yet what I'm hearing you say is the industry itself is effectively a criminal enterprise supported at every level by these crypto cartels. Why is there a disconnect? Because if you're out there in the public, more and more people seem to be talking about crypto, right? There seems to be more of an intellectual acceptance of digital monetary system. So you're saying at one point, on one side, that, hey, look, this is an industry ripe for fraud and there's really no demand. But on the other side, we're seeing more of a public acceptance.
I disagree. I don't think we are seeing public acceptance, not anywhere near as far as we saw in the last cycle. So in the last cycle, it really did feel like it was going mainstream. Tesla had put Bitcoin on its balance sheet and, all these celebrities were getting involved and, just the everyday person, was all they could talk about was cryptocurrency. Every day, some new company was getting involved in the space, some traditional brand, a football team or a sports team or whoever, a car manufacturer. They were launching an NFT collection. So it felt very mainstream then. I don't think that's the case now. I think the case now is it's people who have been in the industry for a long time and who have become acclimatized to all the malpractice. Because I think for a lot of the mainstream people last time, once they saw the very public and very conspicuous malpractice following the collapse of FTX and Luna, that put them off the space. And they had never seen anything like that before. And then they left. I think the people in it now, they kind of know what's going on and they just don't care. For example, I just read a piece just yesterday, actually, about the link between some of these very big and very prominent VCs and some of the malpractice in the space. Now, take some of these decentralized exchanges, for example. These are preferred means of money laundering for North Korean hackers. So a lot of the biggest hacks in crypto are perpetrated by North Korean state-affiliated hacker groups, in particular one group called the Lazarus Group. Now, they just hacked a company quite recently for several tens of millions and laundered that a lot through this platform called Uniswap, which is the largest decentralized exchange in the space. Now, Uniswap has huge backing from very high-profile VC firms, from in particular ASIC. So these VCs make a lot of money from these projects that they're backing, in the token allocations that they receive when they liquidate, in the fees that the Uniswap generates by token swapping. And even if those fees are coming from money laundering, who cares? And they have a very convenient narrative to fall back on, which is that this technology is decentralized. They can't help who uses it. They can't help if money launderers use it. They've built this code, it's permissionless, it runs by itself. So, there's nothing they can do. So, they just see kind of crime as a side effect or a kind of side product of this, an unavoidable consequence, as opposed to taking any steps to combat it.
Well, can you give me and the listeners just because I've always wondered this since it happened, would you a short summary of what exactly, maybe the top 3 things that FTX did that was illegal, and then what they actually got caught for?
Yeah, sure thing. I think that's a really interesting question. What we need to remember, what people need to realize about FTX is that they weren't even hiding in plain sight in terms of the illegality of what was going on there and the malpractice. Everyone knew what was happening there, and to some extent anyway. Maybe some people didn't know the full severity of it or whatever. But everyone who worked in crypto knew that FTX, the only market maker on FTX was Alameda, and that Alameda shared the same office with FTX in the Bahamas, and that the CEO of Alameda was Sam's ex-girlfriend. Everyone knew these things were happening. Everyone knew that there were these conflicts of interest that just shouldn't exist. These red flags that were there. Now, in terms of what they did, pretty much everything. They were doing all the kind of standard market manipulation, which is very prevalent across the space. They were doing token sales on the platform, IEOs, and that kind of thing. They were washing volume. What they got caught for was the misappropriation of user funds. So they were commingling funds, basically. So Alameda was gambling on the crypto markets, and they lost a lot of money by doing that. They lost a lot of money. They were massively over leveraged on Terra Luna. When that collapsed, that kind of brought down a lot of projects in the space: Three Arrows Capital, Celsius Voyager, all these things, and including FTX. And what Alameda was doing was essentially using FTX as its own ATM. Whenever they had a black hole in their balance sheet, Sam would just wire Caroline and Alameda as much money as they needed. Now, what happened was there was a bank run on FTX. Users withdrew their assets because there was this article that came out in CoinDesk by a journalist called Ian Allison, which said that I think the headline was "Blurred Lines in Sam's Empire" or SBF's Empire, something like that. And there was the balance sheet was leaked, and it showed that Alameda was holding a lot of this FTT token, which was the token launched by FTX. So there were, that kind of raised the mass alarm to people who weren't really in this industry, didn't work in the industry, that, things weren't right at FTX. And what happened was people started withdrawing their funds. When that happened, there weren't enough funds on the platform for FTX to cover. It was a classic bank run, and then that's really what brought it all down. A lot of it was orchestrated by a rival exchange as well. Rival exchange, Binance. Binance held a massive position in FTX's token, FTT, and because Binance was an investor in FTX, and when this news came out, that gave Binance the excuse to start selling their FTT token. Now, because so much of the FTX and the Alameda balance sheet was propped up on this token, it was their solvency was and their liquidity was reliant on this token, which they had created themselves. When Binance and CZ started selling their FTT, after it got to, there was a certain price it had to hit. It was around $22, where after it went under that, and the whole house of cards was going to collapse. FTX and Alameda just wouldn't be solvent after that. And they were taking out loans collateralized in FTT. So they'd take out $1 billion loan and they'd put up $1 billion of FTT in collateral. Now, the condition of those collateralized loans was that once FTT falls below a certain price, then the loan has to be repaid as well. So they weren't able to repay those loans. So what was happening is they were being attacked on multiple fronts, right? They had this bank run, which they couldn't meet the redemptions. They had these loans which they couldn't repay, and which they were receiving essentially margin calls for. All of that pressure led them to collapse. So that's what's happened. They got prosecuted for basically every financial crime under the sun, commingling of funds and that kind of stuff. But a lot of the details around the collapse of FTX didn't really come to light and didn't really receive any attention. And it's those details which I really focused on when I discuss FTX in the book, the things that aren't so publicly known. So, for example, after the collapse of FTX, the exchange was still working. You just couldn't withdraw your money. So you had your balances. People had their balances on the exchange. They were just numbers on a screen. But they could use their balances to still trade tokens, even though there were no tokens there. It was all just numbers on the screen. And they could internally transfer their balances as well. Now, even after FTX halted withdrawals, some accounts were still allowed to withdraw. Now, SBF was based in the Bahamas. And the Bahamas is an island. It's obviously a very beautiful place, but it's also an island with a lot of gang activity. And some of the only accounts allowed to withdraw were accounts based in the Bahamas with Bahamian KYC'd accounts. And people were speculating this was because SBF was feared for his safety. So what people were doing, people with very large balances were paying people with Bahamian KYC'd accounts to withdraw their funds for them. So it was a case of, the whales on FTX were the first ones to the lifeboats. They were paying people to withdraw their funds for them. If they couldn't find anyone to withdraw their funds, what they were doing was they were paying former employees of FTX who still had access to the exchange and all their work systems. They were paying them to fraudulently grant these people KYC'd accounts to the Bahamas. So they were buying fake Bahamian accounts or fraudulent Bahamian accounts and then withdrawing their money through that. So it was a very, very bad situation all around. Influencers were posting on Twitter very publicly, I will pay someone at FTX $250,000 to give me a KYC'd account to the Bahamas. And 2 hours later, they would then brag about this and post a screenshot of their $5 million withdrawal. So this was all happening as the exchange was collapsing. And then it got even worse after that, where these people with Bahamian accounts were offering to withdraw money for other users of the exchange. So they were taking payments for that, but then just after they had withdrawn the funds that they had received via transfer, they just weren't sending them back to the person who had transferred. So they were not only were they kind of committing fraud in terms of withdrawing their funds, they also were stealing from other people. It was real looting during the Blitz, is how I describe it in the book. So this stuff was all crazy, but with everything going on, all the headlines were dominated by the collapse, and stories like these didn't really come to light, even though I think that is some of the worst activity to have come out of that whole situation.
So looking at FTX as an example, one could say, or what would you say to this statement? Well, yes, there's always bad players in an industry, especially in an industry that is in its development stages, as they build out the infrastructure of the industry, the plumbing, regulators working internationally together. So FTX was just, they were just a bad player, a bad example, but they're not endemic throughout the industry. What would you say to that?
No, I would completely disagree with that. It's everyone. It's everyone. And actually, the stuff FTX was doing, other people are doing worse stuff. They're doing it even more egregious stuff than that, I would say. Maybe not on such a big scale. Maybe they don't have the same amount of money that FTX did or the same amount of user balances or whatever, but they're doing even more brazen stuff than that. No, it's not because of that. And also, let's not forget that FTX was also regulated in the US. That they had it was FTX US and FTX International, and even FTX US was fraudulent. So no, it's not just a case of a few rotten apples. It's everyone. It's pervasive. It's look at Binance. I mean, the founder of Binance, CZ, is in prison right now. CZ and SBF were the two biggest people in crypto, and they're both financial criminals. And it's really everyone.
Here's a question for you. But then you have a guy like Michael Saylor out there, right? MicroStrategy. And he has personally got billions in. His company's effectively his treasury stock. You've got Venezuela. I mean, are these people that wrong? I mean, or are they preaching a message that will support it was to their own benefit? I mean, I could see why Saylor wouldn't come out and say it's a scam because he's got so much money in it and he's so public. For those of you listening who say, well, that possibly can't be. Well, go back and research about 1986, 87 through 94 and the penny stock days. When I got into business, we would put out a stock at 10 cents, but 5 cents of that were commissions. And then these companies were just garbage companies. And so they pretty much went through and they wiped out. I mean, there were brokerage firms, investment banks, they wiped out an entire industry. Are you saying that Michael Saylor is wrong? Not him personally. Him personally. He's wrong. That digital and Bitcoin is not the future.
Yeah, I mean, Saylor's just an idiot. He's a weird guy. He's just in Bitcoin. He's not in crypto. He would be the first person to make a distinction between Bitcoin and crypto. And a lot of other people make that distinction as well. They say Bitcoin is not crypto. I think Bitcoin, I got asked this the other day, is Bitcoin a Ponzi? I don't think Bitcoin's a Ponzi. I think Ponzi's are very specific. There are lots of Ponzi's in crypto, but that's a very specific type of scam. I think Bitcoin is just a manifestation of the greater fool theory. You buy it in the hope that an even bigger fool than you is going to come along down the line once the price has gone up and buy it for you, and you make a profit off that. I just think Bitcoin is shit, for lack of a better word. I think that it doesn't really. I mean, what's the point?
Let's explain, or if you can go further on the demarcation between when you talk about crypto versus Bitcoin, just what is, how would you say there's a difference between the two?
Well, Bitcoin is just one individual token. I mean, Bitcoin is a cryptocurrency, but then there's the crypto industry, and it's not necessarily me making this distinction.
Okay.
People say, well, Bitcoin isn't crypto. Bitcoin is just a means of making kind of peer-to-peer payments. It's just a public ledger. Is Bitcoin, and the same with other L1. I mean, it differs from Ethereum in that, whereas Bitcoin is just peer-to-peer payments. Ethereum is a supposedly distributed and decentralized computer network, which anyone can contribute to and anyone can use. But Bitcoin is just a payment network. It's a ledger of payments online, and it's a means of kind of transferring value without an intermediary. Well, supposedly that's what it's meant to be. But I think it has a lot of problems, and while I don't think Bitcoin in itself is a Ponzi or anything like that, I think a lot of the narratives around it are incredibly disingenuous, bordering on fraudulent. For example, decentralization. I mean, it's just not decentralized. It's so much of the circulating supply is controlled by an oligarchy of individuals. Michael Saylor, the Winklevoss twins, some of the exchanges. It's a centralized narrow pool of individuals who control most of the network supply. Most of the hash rate, so most of the new bitcoins which are mined, it's something around 50% of all new bitcoins mined are mined by, I think, about 3 or 4 mining companies. So half of the hash rate is being mined by 5 people. That hash rate of those 5 miners is flowing into one wallet controlled by one custodian. So you've got half of the new Bitcoin you've got half of the network basically being run by 5 companies, with all the new Bitcoins mined going into one individual wallet. So it's not decentralized. I think it's very inefficient. It uses a vast amount of energy. I think it's mainly used for speculation. I think it's the primary purpose of Bitcoin is speculation. I mean, people say, oh, it's a great way of, like remittances, for example. It solves the remittance problem. But, things like PayPal already exist. PayPal, which is free to use and pretty much instantaneous. Whereas Bitcoin, it can cost a lot to send transactions, and it can be very slow. The network doesn't have a high TPS rate at all. But crypto and Bitcoin really are, I would say, that they're solutions to problems which don't really exist. I don't really see, I got asked again the other day how, whether any of these things can fit into the financial system. I don't really think there is a place for them. Even aside from the frauds and the scams and all the malpractice endemic to the space, there really is no innovation there. I mean, ledgers and, ledgers of payments have existed for centuries. And, having a ledger on a blockchain, it doesn't really, no one also really cares about the technology underpinning Bitcoin. They care about the number on the screen, because really the technology underpinning it is quite banal. They care about the price action, the volatility, and I think it's essentially a speculative form of gambling, despite what Saylor might say in his weird rants.
Yeah, I would agree with you. I made the comment back in, I think it was back in November of 2023 when the CME, where futures were going to be offered. And I said to, my Discord group, I said, well, there's the end of that. And they said, what do you mean? I said, look, when you let Goldman and JP Morgan and Citadel and BlackRock, and they're going to trade in derivatives, they're going to use those derivatives to manipulate the price of Bitcoin. And they have the ability to do it. Then I saw that they are also, some of the bigger firms are doing tokenization of individual stocks, which just blew my mind, right? And you only do a derivative because either A, you want the multiplying effect of lack of accountability or the multiplying effect of leverage. And I think every time there's a derivative, other than an option contract or a straight futures contract, which is only a first level derivative, your chances of fraud go up exponentially. And it's usually fraud committed by the biggest players. And that ties into what you're saying about, 50% is going into the same wallet, right? But I've often heard that Bitcoin is an inflation hedge and it's a store of value, and that Ethereum and DeFi are the future of finance. I mean, is there any truth to this, that that Bitcoin is going to save it? Because I just saw in the news yesterday that they think that every single U.S. citizen's social security number had been hacked. Nobody cares. So when they talk about, well, you can do transaction with this ledger system, which you can't change, I think people look at it and go, so what? Can I go buy gas with it? Can I go out to eat with it? Has it been, and I still have to convert it to fiat money. So there's not an ease of transaction by any means. I mean, when I look at ease of transaction, I look at my mother, right? 70 some years old. I mean, my gosh, it was hard enough to get her to stop writing paper checks. And now she's going to use Bitcoin. So this pounding the table that Bitcoin is the future, it's an inflation hedge and a store of value, and Ethereum and DeFi are the future of finance. I mean, what would you say to that? I mean, I know what you would say, but tell me why you disagree with.
I think it's a great question. I think that, the store of value argument really has no truth in it at all. Nothing that volatile can be an actual store of value. I mean, that's, having looked at the charts today, but 10, 15% swings in the price of Bitcoin in a single day are really not uncommon, and it can be a lot higher than that. In terms of an inflation hedge, I mean, Bitcoin was trading higher in November 2021 than it is now. That was what, nearly 3 years ago, and inflation has been what in that time. So it hasn't hedged inflation, and it's not a store of value. I think these are narratives to draw people in. I mean, it's the same with Ethereum, like you said, the future of finance. Until relatively recently, until a couple of years ago, people were saying that Ethereum it's going to bring down the banks, and like I said earlier, people were putting these these money markets on the blockchain and creating decentralized finance and all that kind of stuff. I think with all the fraud, all the scams, all the hacks, everything like that, those narratives have completely gone. So many projects didn't deliver on their roadmaps. So many projects didn't, launch any product or, bring anything to market, and they just ran off the funds they made. They orchestrated these rug pulls. So I think once you get rid of those narrative, what's really left? You're left with a few things. Well, first of all, you're left with the meme. So you're left with the likes of Dogecoin and these Shiba Inu and these meme coins which have been popping up now. And really, that's the only kind of pocket, or it's one of the only pockets of retail interest left in the space. And then you're left with crime. I mean, the other pocket of retail interest is betting markets, gambling markets, notably Polymarket, which is a very prominent, it's very in the crypto space. The reason why Polymarket has become so prominent recently is because political betting in the US is illegal, but Polymarket offers those markets. It's supposedly decentralized or whatever. It's a crypto platform. So it's supposedly not available to use in the US, but that's incredibly flimsy, and it's so easy to bypass that, and that prohibition is not enforced. You're seeing crypto being used to skirt or evade the law. And it's the same with sanctions evasions. Tether is currently under a massive joint investigation by the US and the UK for its role in sanctions evasion in Russia. Tether is sort of flowing into this Russian exchange, and people are doing business with Russia via Tether and bad actors in other nations, so that they're evading sanctions using crypto. And just for crime, really. So, But with these narratives kind of, dissipating as well, the industry is really kind of showing its hand. So, take the Ethereum narrative that I was saying just now, right? Gone are the days when the Ethereum proponents were saying, "Oh, we're going to bring down the banks." Now they're all begging the banks to launch ETFs on Ethereum because because that's what's going to get the price up. And same with Bitcoin as well. It used to be about getting rid of intermediaries and permissionless payments and that kind of thing. A kind of hedge against government and everything like that. Now everybody wants Donald Trump to speak at the Bitcoin conference. And everyone wants, again, Bitcoin ETFs, and they want institutions to adopt it because that's bullish for their bags. So these false narratives are one by one, peeling away, and the industry is showing that it's always only ever been about the number on the screen going up. And I think there's certain irony in that.
But okay, Jake, but let me ask you this question. Isn't there some level of affirmation to the credibility of digital crypto products because central banks are now rushing in and wanting to offer their own? I mean, if structurally these are effective, they're not Ponzi schemes, but they're pure gambling, why would central banks be getting involved?
Yeah, that's an interesting one. CBDCs. I mean, the Central Bank of Nigeria tried that a few years ago. I don't think banks are really looking at that too hard. The Central Bank of Nigeria tried that a few years ago with something called the e-Naira. So it's a CBDC of their currency, and they ran a massive ad campaign around this and really tried to get adoption going. And nothing happened. There was no adoption. I don't know what's happened to the scheme since then, but it was a huge flop for them, and it was very, very embarrassing. So I don't know how many banks are actually seriously looking into this. Again, supposedly crypto, again, another narrative around it is that it banks the unbanked. And I think that's one of the reasons why Nigeria was adopting it, because a lot of their population didn't have bank accounts, but they had smartphones. Everyone there had a smartphone. So you could, set up a wallet or whatever on your phone, and then do CBDC payments like that as a bid to move away from a predominantly cash-based society. I don't think that's a good narrative or a genuine narrative, because you saw that Nigeria didn't get the adoption because if someone doesn't have a bank account and doesn't understand how the kind of basic banking system works, or doesn't want to get involved with it for any reason, why would they want to use CBDCs, which are a much more complicated concept and form of technology? They'd have to get a crypto wallet and this kind of stuff, and learn how it all works. So I don't think it's a viable way to bank the unbanked, or to provide financial services to the unbanked. So I'm skeptical about how many central banks are legitimately looking at these things. And when they have looked at these things in the past and rolled these things out, the rollout hasn't been good, despite huge campaigns and huge efforts to make it a success.
If you had one single message that you could convey, that you want readers of your book and listeners to this podcast about crypto and about the space and the industry as a whole, what would that message be?
Yeah, I would say stay away, pretty much. I'd say that the whole industry is a fake. I really worked very, very deep in it. I worked with some of the biggest people, some of the biggest projects and companies. And I worked with a lot of the medium-sized companies and a lot of small companies. And they all have one thing in common, which is that they're all out for themselves. And they really just kind of want to get by any means necessary. This is an industry which is persistently and incorrigibly ignored the rules and thought the rules don't apply to it, flouted regulation, and every type of fraud is happening. It's happening every single day. So I'd say tread very cautiously there, and if possible, stay away.
So, how about this? When we started talking, I looked at your background and everything. Obviously, it's very compelling, and your philosophy of uncovering fraud in telling people what the truth is behind an asset is very much in line with what I'm doing and trying to share with people 30 years experience being in the business, the financial business, and how it's set up to screw people. For the crypto side of it, or for your experience, your crypto experience, what would you say to this? Because this was one of the comments I came up with was, well, wait a minute, Jake, didn't you make your money in the business and then you exited, and didn't you benefit from the same Wild West sort of environment that you are now speaking out against? Well, is that accurate?
I think that's a very valid question, and I appreciate you asking it. I would say that, without wanting to get too personal or go into the details of it, I really didn't make that much money in crypto. I really was averse to these a lot of these practices from the offset. So I obviously had a salary. I was, a founder of these companies, and I was the head of communications. So, I had a salary which was in line with the head of communications in other industries and other, in other sectors. But I didn't want to get involved in the insider trading. I never really invested very much of my money into it, even when I was working in the industry. But I never really traded. I used to play around with protocols from time to time. I used to do this. It's really quite, it's a pretty awful practice. Not because it's, it was leverage yield farming, which was just, we're talking about, volatile financial instruments. That was very, very volatile. That was yield farming and doing that stuff, but with leverage as well. And I lost a lot of money from doing that. So, whenever I did use it, it was mainly just to kind of play around with protocols and to, see what it was about and to, kind of have a punt. It was more kind of for fun. So I wasn't. Yeah, I was on. This is why the book is called, from the front lines of fraud. In that I was working in this space, but the whole time I was there, I wasn't very enamored with it, and I didn't like the malpractice. And I, for a lot of it, I obviously was involved with these companies and seeing the stuff going on, but I would try my best not to actually get involved. So I didn't make that much money. I left the industry, and just trying to, I felt very bad. This is why I actually wrote this book, because I felt bad if I just kind of walk away and just go and do something else. I have since gone to do something else, but I would feel bad just kind of leaving it all behind and pretending it never happened, because a lot of people do that when they leave the space. I was like, well, look, I've got all this information, and so many people have been damaged by this industry that I used to work in. I want to get this message out there to, hopefully serve as a cautionary tale and let people know what it's really like.
I think you and I have a lot in common, because when I entered, it was penny stock day. So I saw it was blatant manipulation. One office would sell I think the firm had over 20 offices. And if you got this crappy IPO penny stock at 5 cents, knew that you were going to sell it to the Chicago office, and the Chicago was going to sell it to the Philadelphia. And every time you would go down that line, you'd increase the price. It was pure manipulation, right? And it was to allow our firm and the best clients to get out. Seeing that, I did question. I said, my God, you are in this business, and it's just full of criminals. And yeah, it is. There are good people in it, but they're limited by the regulations and the structure of the business. And I decided I was going to be one of those people, that I was going to do what I thought was right. And it sounds very much, I retired just, a year and a half ago, and I had to do something. And I decided to use the knowledge I have to teach people. And it sounds like you're doing that, but there's a difference. See, what you're doing, you're talking about major criminal organizations or banks or any of the big money people are not going to be happy with your book, right? You're effectively calling out an industry that's a complete fraud, and they're not going to be happy with that. Are you concerned for any blowback from what you're revealing?
Yeah, you're completely right on that point. And, also we need to remember this is an industry which is very experienced in weaponizing the law as well. So there was a huge risk bringing this book out, and that's why Jake Donoghue. I can't remember if we covered this at the start, but Jake Donoghue is a pseudonym that I had to write the book under. I couldn't use my real name. That was on advice of the legal counsel that we took when reviewing the book. A lot of the names of people that I work directly with have been changed, because a lot of the information in the book hasn't come out to the public yet. So these things are quite common with whistleblowing, kind of exposés of this type. But yeah, we had to take precautions. I've got a very, very good publisher, who are very supportive of the book and who have given it a lot of backing. So, I'm not sure if there will be backlash. I think, we've taken, or I'm not sure if there can be backlash. We've taken precautions, and also everything in the book is 100% true. I've got just archives of materials and, messages and that kind of stuff, which I've kept. Everything is true and able to be substantiated. So, if there are, lawsuits, libel, defamation, that kind of stuff, the people bringing those lawsuits would lose as well. And, we'd be willing to, to fight a case all the way to trial, and, have the resources to do so. So, we're prepared, and, everything like that. And yeah, I think that there are risks, but it's a necessary tale. It's a necessary story to tell. So,
since you have so much technical expertise, I have this question, and I always pose this. In my Discord group, we've got a number of people that really love Bitcoin, and they're very much about the future of Bitcoin and more the technology side of it and digital transaction. And I get that. I understand it. But, you can do all that with just regular fiat money. And you still have to transfer any of these coins into fiat to be able to use it, as you said. But I guess my question is, in 2028, the first commercially available, supposedly, quantum computer is going to come out. For those of you who don't understand quantum computer, it would be pretty much like taking today's computer and comparing it to an Atari 2600 that's playing Pong. But take it to the 10th degree. How is the protocol? How is the actual anonymity of the ledger technology on Bitcoin? How is that going to survive that level of computing power? I mean, they're going to be able to hack I think I saw an estimate. They said it would take about 10 to 15 minutes before they could hack a wallet using quantum computer. So what is the industry's response? Because I've heard nothing, right? But you were in the industries. The industry just don't care. We'll figure it out. I saw Ethereum a year and a half ago said, well, we're working on that. What do you think? I mean, with the proposed or the expected explosion in computing power that's going to be available to the public?
Yeah, it's a really good question. That's probably slightly above my pay grade in terms of technical expertise, but I can try my best. It's actually quite convenient. I was talking to a friend of mine fairly recently, who's he's a software engineer and a real technical expert in those kind of things. And he actually brought this up. We were discussing what I used to do in crypto and that kind of stuff. And he said, well, yeah, I mean, quantum computers are going to basically just bring down the entire industry. It's to do with this problem called something along the lines of the double payment problem, where the whole consensus mechanism of the Bitcoin network is to solve this. The Bitcoin network perform the miners, people who run nodes. They're performing very complex equations to verify payments, to make sure that if you're holding one Bitcoin in a wallet and you send it to another wallet, you have to perform an equation to verify that transaction has been made. Otherwise, you could hold the same Bitcoin and send it to two different wallets. That's a very dumbed down and probably not very accurate way of describing this double payment problem. But quantum computing, I'm told, is gonna make these equations that the Bitcoin network solves to verify payments completely redundant, because quantum computing is going to be able to send transactions or to interfere with the network faster than the existing network is able to perform those transactions to verify them and to actually mine blocks and that kind of thing. So that's probably a very inaccurate way of describing what's going on and probably not very helpful. But yeah, to give some indication on that point. And I have had this idea as well that quantum computing is going to be the end, at least for Bitcoin and for proof of work networks, which basically try to they brute force those calculations to verify and kind of hold up the network. So quantum computing is tipped to bring it into that. So it'd be interesting to see how that plays out. But probably need to get a software engineer on to describe it in better detail.
What will be the next to fail? Will it be in another exchange? Will it be a clearing firm? An investment bank? I don't think an investment bank, a venture capital firm that's got its asset in Bitcoin or in crypto. Is it going to be another FTX, or have the regulators made a point and so they're not paying attention? Or what would you say what's the next choke point, the weak point that will fail in this industry that we can be looking for, if there isn't?
Yeah, I've thought about this a lot since. Historically, when cycles end and when bull runs end, it's because of some disaster. It's because of some collapse which has happened. So most recently in 2022, that was FTX. Prior in the ICO era, or it's either that or regulation or some kind of external force being applied to the industry. And in the ICO era, a lot of people attribute that that coming to an end because of these enforcement actions brought against a lot of these big ICOs which were taking place. And obviously there was also there's been the collapse of Mt. Gox as well. Now I thought about this a lot, and I was like, well, is it Binance going down? Is it Tether? That whole fiasco coming to an end and collapsing. Is it some an outright ban or international efforts and concerted regulatory effort to take out the industry? Increasingly, I think it's actually going to be none of those. Increasingly, I think what's going to happen this time is the worst thing that can happen for crypto now, as opposed to a disaster, stagnation. I think, that kind of 55 to 65K range for Bitcoin, if Bitcoin keeps moving sideways like that for a long time, then I think people are just going to lose interest. People who have money in crypto now and keep it in there for a while and don't really look at it and then come back to it, and they're really happy when it really pleased when it's appreciated in value. I think people like that are going to come back to it, and if that keeps happening and this sideways movement keeps going on, people are going to come back to that and say, well, actually this is just pointless. I bought this because it was meant to be volatile and high appreciation, high growth asset, and nothing's happened. And then they'll start cashing out, and there's going to be no real influence. And I think crypto right now runs the risk of calamity by boredom or something along, something think that, with the reputational damage that was done, it's difficult to see how mainstream brands, mainstream institutions will ever return to crypto. I think that, the legacy of FTX is going to live on for a very, very long time. So, unless there's a way of incentivizing or encouraging existing users to keep doubling down and, keep spreading the word. And I think that the industry doesn't really have many places to go, to be honest. I mean, what people in crypto really want is volatility, whether it's up or down. People will thrive on that, and they want the drama and they want the headlines. And if Bitcoin does start going up and it goes over 100K, then I think that's something that could attract more retail. Maybe not even the institutions would still get involved to that level, but it would probably attract more retail and more people wanting to have a punt in it and that kind of thing. But if that doesn't happen and it keeps moving sideways, I think really that's going to be what's done for crypto, because it's really not, crypto's not cool anymore. In the last cycle, it was the flavor of the month, it was the fad, it was what everyone was talking about. Now, no one really cares. A lot of people have left the space, a lot of interest left the space. Most people have pivoted to AI or some kind of new fad or something like that. So yeah, I think that's probably the biggest risk that the industry faces.
They're pivoting to something else that's also a scam, at least in its current iteration. It's just a large language model. It's just so hilarious to me. But, going back to what we're talking about, I think also one of the worst things that could happen is if the big parties, think about it, if you've got JP Morgan, BlackRock, and Vanguard out there, and there's just a couple of them that are out there offering ETF, but they also have the ability through a derivative, through the futures market, to goose the price of the underlying asset of the ETF. Well, as long as they can goose that up, then they're going to attract more money. They attract more money. They get paid fees on the front end as well as the internal fund management fee, as much as they can to attract as much retail money into it. And then the rug is pulled. When you look at a business, you hit right the nail on the head in the very beginning of our conversation, which is they're not producing anything. What do they make? What Bitcoin as an industry, what do they make? And the very thing that proponents of Bitcoin have always hammered on about the US dollar, any fiat currency, was it was backed by nothing. And now I look at digital currency and I say to myself, in crypto assets, well, what are you backed by? What's your hard commodity? It's exactly the same to me anyway. And actually it's worse, because at least with a fiat currency, you do have, as I refer to them, the adults are in the room, even if some of those adults are criminals. But with the crypto industry, there's not that maturity of parties involved. And I think that's one of the points you're making in your book is, look, we're not talking about people that have been in investments for decades. This is really a grab as much money as you can before the door closes. But I just, looking at digital and crypto, even for somebody like me who was in the investment side for 30 years, sometimes it can be utterly confusing, right? DeFi, crypto, and to hear somebody like you who was in the industry say, hey, look, you don't need to know all the details, but here's the salient points. It's criminal, it's a fraud, and it's built on nothing. And here's the proof. Would you agree with those statements?
Yeah, exactly. No, you're completely right there. Yeah, it's backed by nothing, and I mean, it's backed by hype and speculation and narrative as well. That's why, because there is no substance to it, that's why crypto is such a toxic environment as well. That's why it's so cultish, and that's why if you criticize a specific token or whatever, a specific, for lack of a better word, community within the space, particular niche in the space, you get a lot of backlash. You get a lot of vitriol. They're so quick off the mark to jump down your throat, and they'll really be very, very horrendous and very unpleasant when they do that, because the only thing backing it is just this incessantly bullish narrative. and just hype and speculation and FOMO. So any whiff of criticism, they jump at that straight away. And, this is something I've experienced, a lot recently with the very, very critical and skeptical stance I've been taking against crypto. This is something that I think every crypto skeptic has experienced as well. And it's part and parcel of the message that we're trying to convey. But it's because of that, that lack of substance behind it. And it's so weird. You don't get that in actual, in actual industries, do you? If you invest, or, to a much lesser extent anyway, at least, if you invest in an equity and someone starts criticizing the equity, you don't care because, that's backed by revenue, it's backed by cash flows, it's backed by the products that the company invested in makes or the services it provides. There's an actual underpinning there. So you say, well, you can criticize as much as you want. I believe in it. It's a high conviction bet. For as much as people in crypto might like to say that they have diamond hands or high conviction or whatever, they just don't. They just don't. And they need that narrative. They need that incessant enthusiasm and optimism in order to survive. And then, at any side of opposition, they crumble and show their hands and show that really it is all just about the hype.
Yeah, the crypto sector seems to me like it's one huge echo chamber. And in the equities markets, whenever I look at the AMC crowd or the GameStop crowd, I say to myself, I bet you there's a high correlation between you guys owning these two stocks and you guys owning crypto, because it's the same level of mentality. It's the echo chamber, and hey, if you agree with me, then you must be a genius. And if you don't agree with me, you're an idiot. And I see that in the crypto space too, where it's, well, we're smarter than you are, and you just don't see it. And you'll see it someday when GameStop goes to 1,000 and crypto goes to 1,000,000, right? And then when you get down to the details and ask, well, how's GameStop going to go to 1,000 when the move is to online game sales, not walking into a brick and mortar store? And GameStop has a plan for that. It's interesting because GameStop does have a plan for it. They turn their treasury stock, now giving the CEO the ability to trade it in any asset, which just blows my mind, right? And there are large proponents, large groups who are proposing that GameStop convert their treasury stock into 100% crypto, because on the revaluation, the stock would go up to whatever price. And I have to laugh, and I think, well, so we're going to trade a company that not in a growth industry. And now the CEO is so confident in his industry that he's going to trade with the company's money. He's not going to reinvest it in the company. He's going to go trade it. And some of it's going to be crypto. But from what you're sharing with me, your opinion is completely fact-based and experiential-based. And, for lack of a better phrase, you just aren't drinking the Kool-Aid. You're seeing it for what it really is and trying to help your readers and the populace understanding this. But the battle is so huge because there's so much, at least from the retail side, it's almost like Bitcoin's being treated like, it's been around forever, it's safe. There's this assumption, I like what you said, there's an assumption that it will continue to grow. Yeah, if it goes sideways, people are going to get bored and they're going to move on to the next best thing. I always have compared crypto to the tulip, craze in the 1500s. You're literally spelling out how this industry is a fraud, and you are going to get people who adamantly and passionately disagree with you. And that's before they make it personal. You sort of have an uphill battle here, wouldn't you?
I agree. I see that. And I think that it's the people who will be disagreeing with my statements about how fraudulent the industry are people who have invested heavily in this stuff, or who still work in the industry, still work in the space. It's people with a vested interest in it. But I think even the people who work in the space, they'll be able to understand what I'm coming from here a lot. So, for example, I've been speaking to a lot of journalists and stuff, in the run up to book launch next week. And I spoke to one journalist recently who works for a very, very, very specific crypto outlet, works for a specific crypto media outlet. And, they focus exclusively on crypto, and they, really cover a lot of the very technical stuff. And, that they cover, it's like a crypto insiders outlet, the kind of thing, people who are really deep into the space. And it's one of the better outlets out there, in that they don't take bribes or brown envelope challenge or anything. And he's very knowledgeable about the space. He's been looking at it for a long time. He's been reporting on it for a very long time and reporting on really the finer details of it. And he sent me an email back after he'd read a bit of my book, and he said, I've heard and seen just so much of this myself as well. When I've spoken to people kind of off the record, when I've spoken to other whistleblowers or whatever, I've heard all of these things before. So he knew what I was talking about, and I think everyone who's worked deep in the space, knows these things exist. And
I just wanted to ask one last question before we finish. Do you think, Jake, there's going to be a penultimate event where something happens and just the whole industry just comes crashing down? Or is it going to be a slow down?
I think it could be either. You never know. It could be another massive implosion, which brings it down. So it could go either way. But at the moment, I'm leaning more towards this idea of a slow death, of a bleed out, of a loss of interest in the space is what I'm leaning more towards.
Very excited, because anytime a professional, an insider with expertise is able to sort of pull the veil off of something like this, and doing so to protect and to inform people who otherwise would not really know the difference. And I think it'd be good to have you back, and be able maybe to answer some of their history. I've learned a ton already from the podcast. I had no idea about that you could buy legal opinion in order to effectively cover your rear end, so you could get this asset out the door to sell to somebody else. I had no idea the legal opinion was such a big deal. So I would like to invite you back, but also for listeners, Jake is on Twitter, and go ahead and provide your Twitter handle if you wouldn't mind, and if you have a website or anything like that.
Yeah, absolutely. So I'm on at J Donoghue author. That's J Donoghue is Donoghue, and then author just AUTHOR. But yeah, look, it's been really great to speak. I've really enjoyed this conversation. It's been really interesting. I think you've asked some very penetrating, very insightful questions. I'd be very keen to come back and speak at another time if that's if that's on the cards. I'd also be very interested to speak to some of your listeners as well. Maybe I could come into your, like you said, come into your Discord, answer some questions there, perhaps like an AMA or something, if that's something that you do regularly. I know you said that some of your listeners are invested in crypto and are holding crypto. So if they have any questions they'd want to ask, I'd be very keen to answer them.
That sounds fantastic. I think an AMA might be good. I just have to figure out the technical aspects of. And I did get messages back on Twitter when I post the upcoming podcast with you to be timed with the same day that your book releases worldwide. I want to personally thank you for coming on today, and also personally thank you for, lack of a better phrase, doing God's work here and revealing the truth. If listeners, this about me, I just want what the truth is. And if I can't get to the truth, I want what is the highest probability of something being the truth. And I don't think you can walk away from either listening to today's podcast or reading Jake's book and not say, well, the industry has many, many problems. And I'm not hearing anything, quite frankly, other than just, as Jake had mentioned, the greater fool theory is what's pushing crypto up. But I appreciate very much that you came on. I'm very, very excited. I've already started getting some feedback, and I'm going to warn you right now, Jake, that some of the listeners, they think you're crazy. They think that you don't know what you're talking about, that at least the comments I've gotten about the crypto space, that it's matured. So I think it'd be a fantastic back and forth with some of the listeners, and they'll be respectful about it. But, there's a whole segment out there that just thinks that what you're writing is not true, or the industry will grow enough to take care of itself. So any closing comments, Jake, that you'd like to make before we wind up this podcast?
Yeah, I think that on that point, I think that's that's fair enough. Everyone's entitled to their opinion, and obviously I have had that before. I've had obviously comments people saying, "Oh, you don't know what you're talking about, or what you're saying isn't true," and this kind of stuff. And I always try to be respectful. This when you get that, but I think that for the people who are invested in the industry, those are very convenient arguments, and it's not a case of I'm just saying that, trust me, bro, this is true, and anything like that. Everything I'm saying is substantiated, and you wouldn't get a book deal based on just word alone. You have to have evidence for what you're saying, and pretty much the only people I've encountered who have said this isn't true or this isn't correct or whatever, or you're making it up, are outsiders. It would be very, very difficult for. While an insider may deny that there's as much fraud in the space as I'm saying there is, they wouldn't be able to deny that these practices exist and these things didn't happen, because they know these things happened, and everyone who worked in the industry knows they happened. So look, everything is true, everything is substantiable, and I'd be very happy to debate anyone really, because I went through it. I worked in the industry, and with some of the biggest players, and I worked at the highest levels. So always happy to have those conversations.
Awesome. Well, thanks again, Jake, for coming on today. Jake's book, Jake Donoghue, Mr. Jake Donoghue's book, Crypto Confidential, an insider's account from the front lines of fraud. And that'll be coming out on August 22nd, same time that you all be listening to this podcast. And if there is interest, please let me know or let Jake know on Twitter. I'd love to have you back and do maybe a bull versus bear. I think that'd be very interesting to do. I do agree with you, and I'm looking forward to diving into some of the very detailed parts of your book and some of the examples that you provide. So thank you so much for taking the time. I know there's a time difference across the pond, as I guess the British say. And listeners, thank you for taking your time today to listen to this podcast with my special guest. And look forward to the next time that he is here. Thank you.
They ain't got no muscle, no hustle, no backbone. I stand alone, not tripping, just saying I'm different. Ain't hanging on to the